Did you know that every single day, the United States and China exchange over $1.7 billion in goods and services? That's more than most countries' entire annual GDP flowing between these two economic giants every 24 hours. But here's what might shock you even more. When China's stock market sneezes, Wall Street catches a cold within hours. When Beijing announces new trade policies, American consumers feel it in their wallets before the week is out. And when Chinese factories slow down production, American store shelves start showing gaps faster than you can imagine. This isn't just about trade numbers or economic theories. This is about how deeply connected our economies have become, and why understanding China's economic moves is crucial for every American investor, worker, and consumer. The relationship between China and the United States has evolved into something far more complex than simple buyer and seller dynamics. We're looking at two economies that have become so intertwined that separating them would be like trying to untangle a knot that's been forming for over 4 decades. Today, we're going to explore exactly how China's economic decisions ripple through the American market in ways that affect everything from your retirement portfolio to the price of your morning coffee. We'll examine the mechanisms that make this connection so powerful, the challenges it creates, and what it means for America's economic future. Because understanding this relationship isn't just important for economists and policymakers. It's essential knowledge for anyone who wants to make sense of why American markets move the way they do, and where our economy might be heading next. Let's start by looking at the scope of the challenges this economic relationship creates for American markets. The first major challenge stems from what economists call supply chain dependency. Over the past 3 decades, American companies have built their operations around Chinese manufacturing capabilities. This means that when China faces economic disruptions, American companies don't just lose a supplier. They lose access to entire production networks that can't be quickly replaced. Take the semiconductor industry as a prime example. While Taiwan produces most of the world's advanced chips, China controls much of the rare earth materials needed to make them. When China restricts these exports or faces internal production issues, American tech companies from Apple to Tesla feel the impact immediately. But the dependency runs deeper than just raw materials. Chinese factories have spent decades perfecting manufacturing processes for American brands. The institutional knowledge, worker skills, and production infrastructure can't be recreated overnight in other countries. This creates a situation where American companies are vulnerable to Chinese economic policies in ways that go far beyond simple trade relationships. The second challenge involves currency manipulation and its effects on American competitiveness. China's approach to managing its currency, the yuan, directly impacts how competitive American products are in global markets. When China allows its currency to weaken against the dollar, Chinese exports become cheaper while American exports become more expensive worldwide. This isn't just an abstract economic concept. It translates into real job losses in American manufacturing cities and reduced profits for American exporters. The third challenge centers on intellectual property and technology transfer requirements. American companies wanting access to China's massive consumer market often face pressure to share their technological innovations with Chinese partners. This creates a situation where American firms essentially train their future competitors in exchange for short-term market access. The long-term implications of this dynamic are still unfolding, but we're already seeing Chinese companies using American-developed technologies to compete directly with their former American partners. The fourth challenge involves market access restrictions and regulatory barriers. While American markets remain largely open to Chinese investment and products, China maintains significant restrictions on American companies operating within its borders. This asymmetry creates competitive disadvantages for American firms while allowing Chinese companies to build strength in the more open American market. These challenges create a complex web of vulnerabilities that make American markets susceptible to changes in Chinese economic policy and performance. Now let's examine the key factors that drive how China's economic decisions impact American markets. Trade agreements and policy changes represent the most visible factor in this relationship. When the United States and China negotiate trade deals, the immediate effects ripple through multiple sectors of the American economy. Agricultural states feel the impact first when China adjusts its purchases of American soybeans, corn, and wheat. These aren't small adjustments either. China's agricultural purchases from the United States can swing by tens of billions of dollars based on trade agreement terms and political relationships. For American farmers, this means the difference between profitable years and financial struggle. But the impact extends beyond agriculture into manufacturing, technology, and services. When trade tensions rise, American companies face retaliatory tariffs that can price them out of competitive positions in Chinese markets. The consumer behavior factor represents another crucial element in this relationship. China's growing middle class has become a significant market for American products and services. Changes in Chinese consumer preferences, spending power, and government policies affecting consumption directly impact American companies' revenue streams. Consider the automotive industry. General Motors sells more cars in China than in the United States. When Chinese consumers reduce their car purchases or shift toward electric vehicles, GM's stock price responds immediately. The same pattern holds for American entertainment companies, luxury brands, and technology firms that have built their growth strategies around Chinese market expansion. The technological competition factor has emerged as perhaps the most significant element shaping this relationship. Both countries recognize that leadership in artificial intelligence, quantum computing, biotechnology, and advanced manufacturing will determine economic dominance for decades to come. The US-China economic relationship is defined by a paradox: intense cooperation intertwined with deep strategic rivalry. American and Chinese firms collaborate on research and development, even as their governments enact policies aimed at outmaneuvering one another. Technological breakthroughs in either country can rapidly alter competitive balances in critical industries. Capital flows amplify these interdependencies. Over 2 decades, Chinese investment in US real estate, technology, and infrastructure surged, making markets in cities like San Francisco, Seattle, and New York sensitive to shifts in Chinese capital availability. A policy change in Beijing or domestic slowdown can send immediate ripples through American asset prices. Commodities bind the two economies further. As the world's largest consumer of raw materials, China's industrial cycles directly sway global prices, benefiting or burdening US energy producers, miners, and farmers depending on whether its economy is accelerating or slowing. Financial markets now represent another vital linkage. Chinese firms list on US exchanges. American investors hold Chinese securities. Regulatory disputes or accounting concerns trigger volatility on both sides, as seen in debates over potential delistings. Integration creates opportunity, but also systemic risk. At the heart of this shifting dynamic lies China's dual circulation strategy, building a self-sufficient domestic economy while retaining access to Western capital and consumers. This aims to reduce dependency on foreign technology and markets without severing financial linkages. For the US, this presents 2 paths: opportunity for adaptable firms and peril for those tethered too tightly to Chinese demand. The technology sector stands on the front line. If China achieves competitive parity in semiconductors, software, or advanced manufacturing equipment, American firms could lose market access abruptly. Yet the same rivalry is accelerating US innovation, as seen in private space exploration and advanced manufacturing breakthroughs. The shift extends beyond firms to entire regions. Areas reliant on Chinese export markets face acute adjustment challenges. Those investing in innovation, advanced manufacturing, and diversified supply chains could see unprecedented growth. Stock markets are already pricing in these risks and opportunities, rewarding companies with diversified revenue streams. Currency and payment systems may also be reshaped. China's digital currency initiatives and alternative settlement networks could erode the dollar's trade dominance, a development with profound long-term implications for U.S. financial influence. Geopolitical tensions layer on complexity. Economic decisions increasingly intersect with security policy, regulatory scrutiny, and alliance considerations. Both nations are tightening controls over investment, data, and technology transfers, raising compliance costs, particularly for smaller players. Supply chains are at a crossroads between efficiency and resilience. Firms capable of maintaining competitive costs while reducing single-country dependence will emerge strongest. Meanwhile, American consumers face the likelihood of higher prices as production shifts, though automation could offset some cost pressures. The stakes are generational. A decoupling in key sectors could accelerate, fragmenting the global economy into competing systems. Those, whether companies, regions, or nations, that adapt early will be positioned to dominate the next era of global trade. Those that fail risk being left behind in one of the most consequential economic transitions of the modern age.